Welcome to the Investor Coaching TV show. I'm Paul Winkler, your host. We talk about the world of money and investing around here and educate you as an investor, because the more educated you are, the better results you get. Let's face it, nobody can take advantage of you. Today we're going to talk about a few topics that I think you might find of interest. Number one, emerging markets. You've probably been hearing, invest in emerging markets. You know, emerging markets, how well they've done over the past 10 years. And you need to make sure you're there because, hey, it's the future of the world. These countries that are coming about, that are getting into capitalism, that's where the growth is taking place, and that's where the future lies. Well, how should you approach that as an investor? We're going to talk about that. We're also going to talk about time horizon investing, investing based on time horizon. And I'm going to talk about a danger that a lot of you face when it comes to trying to make sure that you match your investment portfolio with your time horizon and what you're listening to. I'm just going to give you a hint. It's what we're listening to that causes us to lose discipline and make mistakes that end up being very detrimental to your future. So, the more you're educated about that, the less likely you're going to be to make those mistakes. So that's what we're going to do today on the show. I'm going to start off, though, with emerging markets investing. Let's talk a little bit about emerging markets. What are they? You think about it, some of these countries that you may think of as emerging markets countries, Chile and Brazil and Israel and some of these small upcoming countries. Well, what's the benefit of investing in emerging markets? Well, they're a great diversifier. In other words, when I put an investment portfolio together, what I want is things that don't move with each other. If I have two things that are always moving with each other, it's kind of like that old joke about, let's say we talk about, if both of us have the same opinion on something, we're having a conversation, one of us isn't needed. It's the same thing with stocks. If I have two things that move together all the time, one of them isn't needed. It doesn't help diversify me. Now, we measure that using correlation. In other words, if I have two things that have a positive 1 correlation, that means they always move together. If I have two things that have a negative 1 correlation, that means they always move opposite each other. What we really get with investing in the stock market and emerging markets is what's called low correlation. It means that sometimes they move together, sometimes they don't. And that's about the best scenario that we can expect when it comes to investing in the stock market. We don't really get negative correlation, but we can get low correlation. This chart actually shows some of that. It's, you look at all these colors and go, oh, yeah, that's a really pretty chart, Paul. But what that's showing us right there is these different colors signify when different countries have really good returns, and when maybe a different country, maybe one country one year has a great return, and then another country the next year, and then another country the next year. Now, if it were really, really consistent, in other words, that one country we knew what was going to be great next year, let's just invest in that country. Forget about diversification. But we can't know that. And that's because everybody in the world is trying to figure out what is going to be the best thing. And what happens, we all tend to cancel each other's bets out. So what we do as an investor is own all of them just to make sure that we're there when that great performance takes place. Now let's drill down a little bit and see what some of these numbers might look like. If we look at the year 1997, for example, and we say, well, what was the top performer in 1997? Well, it was Turkey. Stocks in the country Turkey. About 118% return. Want to make sure I'm there when that happens, right? Well, what happened the next year? Was it Turkey? No, actually it wasn't. It switched to Korea at 141% return. And then the year after that, what happened? Oh, Turkey, repeated 252% return that year. And then, of course, a couple years later, you got, if you look at Russia was the top at 55% return, and then it was the Czech Republic at 44% return, and then it was Thailand at 144% return, and on, 132% for the next country the next year, 161% return, 82. These are really high returns. And what you're noticing here is it jumps around. The country that is best is different, typically year after year. And we don't know what it's going to be. It's pretty random. So what are some of the, we see some of the benefits right here of investing in emerging markets that can get us excited. I mean, wow, we got these countries that are the future of capitalism and how well they're doing. Well, what are some of the dangers that you need to be familiar with as an investor? Well, the first one I'm going to point out is political, and it has to do with property rights. Hey, If it isn't, if you don't have property rights and nobody's protecting your property rights, you don't have an investment. We take that for granted in the United States. We know that if somebody wrongs us, we can head straight to court and deal with the problem there and make sure that our rights are upheld. Not so in emerging markets, or not so much. Let's watch a couple of videos just to get a feel for this and how this actually plays out in some emerging market countries.
Welcome back to the News Hub here at WSJ Live. I'm Simon Constable. Well, in China, getting rich can get you into trouble. John Bussey, the Wall Street Journal, is here to tell us all about this. And you know a lot about China because you were a bureau chief out there.
This is a complicated place, and if
China or the Wall Street Journal?
No, the China. And if you make a lot of money, the resentment that the public feels about that is based on the pervasive corruption that China is still contending with. This is a new, burgeoning, fast-growing economy, and they have troubles, these dislocations.
So you think about it, there's the problem right there, corruption. All of a sudden we've got a government in charge making the decision, making the rules, deciding who gets to become wealthy, and what happens is that corruption creeps in. Now you think about it. One of the most basic things that makes a country work and makes an economy work is the rule of law. If you don't have the rule of law, then no business wants to move into a country because they're worried that if they do something, maybe they have a patent or they have some kind of a process that they come up with, that nobody will protect their rights, and therefore there is not the opportunity and the ability to make a profit. So the rule of law, we pick on lawyers all the time. I mean, think about it. Think of all the lawyer jokes. But if you think about it, lawyers and the rule of law and upholding the rule of law is incredibly important in a capitalistic economy.
So a group of researchers looked at the issue of companies that get a lot of publicity on these famous, top 50 lists, the billionaires list or the millionaires list. And then what happens to the companies and what happens to the individuals who lead those listed companies. And what they found was quite interesting. Very soon after they make the list and they get the publicity, the share prices begin to decline. The companies themselves are more subject to the government cutting off subsidies to them, and the individuals who lead them are more subject to investigation. Why that is actually quite interesting.
So isn't that interesting when you think about it, that the government steps in, and that's another problem here. We've got the government stepping in and deciding who's going to be the winner and who is going to be the loser. Let's say if you've got a company that does very, very well in an emerging market country. All of a sudden, when they start to do well, the government says, hey, you don't need our help anymore, and then they step out, and things go south pretty quickly. So that is one of the problems that we run into, is the government deciding who the winners and losers will be.
Now, one thing that you have in your column here, it says roughly over the whole world, this gives an idea of sort of wealth distribution. In the whole world, there's about 1% of global households hold 40% of the world's wealth, right? Private wealth. And in China, it's 0.4%. Which is minuscule, controls 70% of the wealth.
You think about that. There is such an incredible concentration in wealth in some of these countries. Now you've got another issue where the population says, hey, we're not being equal here. We're not all benefiting from this great growth in our country. And you as an investor may be investing in that country, and all the time there's all kinds of political upheaval, and the populace is getting a little bit upset, and that can cause your investments to go south. So a couple things I want you to be aware of here as an investor. Number one, you got emerging markets. Property rights are one of the key things that you've got to concentrate on as an investor in those countries. Political instability can creep up at any point in time. Now, as an investor, what do you do? What do we do to protect ourselves against all of this stuff that we're talking about? Well, what I want you to do as an investor is limit your exposure. Typically only 5, 7, maybe 10% of your portfolio ought to be in emerging markets countries. Very important that you heed that, because if you get too concentrated, you're taking too much risk. And make sure in emerging markets that you diversify. Who were the losers? Remember who he said the losers were? The biggest companies. A lot of times, all people invest in emerging markets are big companies. Make sure you also hold small emerging market countries in your portfolio and value those two things that typically people overlook. Tell you what, we're going to take a quick break, and what we're going to do is we're going to get into time horizon investing and how you can be more successful if you know your time horizon, and how you can avoid some of the traps that investors fall into when the media starts to get involved in telling you what to do with your investments. We'll be right back after this.